Ladies and gentlemen, good day and welcome to the Q1 FY26 earnings conference call of Belrise Industries Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on a touchtone phone. Before we begin, a brief disclaimer. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on the date of this call. These statements are not the guarantees of future performance, and it may involve risks and uncertainties that are difficult to predict. With this, I now hand the conference over to Mr. Shrikant Badwe, Managing Director from Belrise Industries Limited. Thank you, and over to you, sir.
Thank you, and good afternoon to everyone. I extend a warm welcome to all participants in our Q1 FY26 earnings conference call. I am joined today by my sons Sumed and Swastit, our CFO Mr. Rahul Ganu, our CMO Mr. Sunil Kulkarni, and our investor relation partners SGA. It's been just over 2 months since Belrise was listed on the stock exchanges, and this milestone continues to be a source of pride and responsibility for all of us at Belrise. The IPO proceeds have strengthened our balance sheet, enabling us to fully repay rupees 15,960 million debt in May month and giving us greater financial flexibility for growth investments. For those new to Belrise, we are one of India's leading integrated automotive system suppliers, serving two-wheelers, three-wheelers, passenger vehicles, commercial vehicles, and agri vehicles. Our portfolio spans safety-critical products such as metal chassis systems, exhaust systems, polymer components, body-in-white structures.
Hello, sir. We are not able to hear you. Hello. Shrikant, sir.
There's some problem with the connection,
Yes, sir.
so
Now
we can
I can.
continue in the meanwhile.
Yes, sir.
Am I audible?
Yes, sir. You're audible
Yes.
now. Yes, sir. Please go ahead.
Yeah. Yeah. We are the largest player in the Indian two-wheeler component segment, holding a 21% market share and have built long-standing partnerships for 30 domestic and international OEMs. Nearly 1 out of 4 two-wheeler chassis on Indian roads or exported from India is manufactured by Belrise, a testament to our precision engineering capabilities. We ended the quarter with total revenue from operations of rupees 22,622 million, which is up by 27% year-on-year, including manufacturing revenue of rupees 18,323 million, which grew 29% year-on-year, showcasing yet again an outperformance against the industry for the company. This was supported by stable growth in two-wheeler, specifically in exports and premium vehicles, increasing content per vehicle, commercialization of the new Chennai facility, and successful integration of H1 India into our basket of offerings. Our EBITDA stood at rupees 2,805 million, with margins at 12.4%. This is in line with our guidance for stable EBITDA margins as compared to financial year 25, where we registered an EBITDA margin of 12.3%. A significant highlight this quarter was the commissioning of our new facility in Chennai, which is now supplying to marquee two-wheeler OEM and a marquee commercial vehicle OEM as a single source supplier across multiple components. This adds to our ongoing capacity expansion initiative with new plants in Pune and Bhiwadi on track to ramp up operations in the coming quarters. Last month, we declared our final dividend for FY 24-25, amounting to 11% of the face value of our share. This marks our first dividend distribution since transitioning to a publicly listed company. We look forward to continuing our good journey in partnership with our shareholders and creating long-term value for all stakeholders. With that, I now hand over the call to Swastit to discuss who will take you through our key order wins. Thank you very much.
Thank you all for joining the call. Coming to the operational highlights for this quarter. Number one, as my father mentioned, this quarter we commenced supplies from our newly inaugurated Chennai facility, which caters to two key customers. One, a leading premium two-wheeler OEM, and two, a leading commercial vehicle OEM. For the two-wheeler OEM, we're now delivering 2,000 exhaust systems and 500 chassis systems per day. Volumes achieved at a rapid pace and aided by strong customer demand. In addition, we started supplying the ATS bracket to a leading commercial vehicle OEM, a product developed over 12 months and now poised for a sharp ramp up. The Chennai plant is expected to continue scaling over the next 2 to 3 quarters with a targeted annual turnover of 2,000 to 2,500 million at its peak. We're also in discussions with a couple of other OEMs for nominations and new product supplies. Moving on to the second order win. In quarter one of FY26, we made our maiden entry into the medium and heavy commercial vehicle segment with an order win for long members from a leading Indian commercial vehicle OEM. Long members are an integral structural part of the chassis system in a commercial vehicle. To cater to this business, we are setting up a dedicated plant in Pune, expected to go live by the end of quarter 2 FY26. This facility will have a capacity of approximately 60,000 long members per year with an average content per vehicle of around 23,000 rupees per unit, translating to a peak annual turnover of close to 1,500 million. We're already in advanced discussions with other large OEMs in the space, and we expect this plant to also export to support their requirements as well. The long member, just to give a brief, is a critical component of the medium and heavy commercial vehicle chassis, manufactured using high tensile steel of up to 900 megapascals. The bending and forming of this structural part involves proprietary processes that require extensive validation and testing. Our acquisition of H1 was instrumental in completing this validation, leveraging the global expertise in high tensile steel forming. As mentioned on the earlier call, this acquisition has enabled us to work with steels of up to 1150 megapascals, almost twice the Indian industry average of 600 megapascals. The high tensile steel strength allows us to produce components with half the thickness, yet greater durability, resulting in lightweighting benefits and improved compliance with crash safety norms. Having worked on this product for over 18 months, this order win marks a significant milestone in strengthening our presence in the commercial vehicle segment. With this win, we reaffirm our guidance to double our four-wheeler and commercial vehicle revenue within the next 2 to 2.5 years compared to FY25 levels. Third, we also signed a general purchase agreement and received a vendor code from one of the top 4 leading electric two-wheeler OEMs in India. We've been engaging with this OEM on multiple RFQs for over a year now, and the signing of this general purchase agreement marks the beginning of a relationship that we expect to strengthen and grow through continued collaboration. Fourthly, this quarter we commenced serial production of a patented combination braking system, or CBS, for one of India's top 4 electric two-wheeler OEMs. This system, designed and developed in-house over the past 2 years, marks a key milestone in our braking technology portfolio. As we scale up with this OEM, we see strong potential to introduce the solution to other leading manufacturers, contributing approximately 2,500 rupees to our incremental content per vehicle in our portfolio. We're currently supplying close to 5,000 braking systems per month across a couple of OEMs, and we expect these numbers to go up based on increased demand from the respective OEMs. Fifth, we've completed the development and approval process for the chassis system of an upcoming electric three-wheeler from one of India's leading two-wheeler OEMs. Production for this program is expected to commence in the second quarter of this fiscal year. Sixth, coming to our new plant, our Bhiwadi plant is scheduled to become operational in the second quarter of FY26. This facility will cater to 2 leading passenger vehicle OEMs and 2 two-wheeler OEMs. The orders for these programs were secured last year, with development ongoing, and as we speak, the ramp-up is expected to commence by the end of FY 2026, by the end of quarter 2 of FY 2026. This will enable revenue generation shortly thereafter, and we expect this plant to contribute considerably to our revenue going forward. Lastly, as we mentioned on our previous call, we had highlighted that our capability to design complex engineering products with precision durability is highly applicable to high-growth adjacent domains. In line with that, in the aerospace and defense segment, we received an additional order from an Indian defense OEM for its armored vehicle platforms. We also secured our first confirmed orders from 2 new defense OEMs, one Israeli and one Indian, for their components, again in the armored vehicle programs. While the current order values are modest, they signal a growing penetration in the segment, our precision engineering capability, and also lay the foundation for deeper engagements ahead. For the next 2 years, as we mentioned, we have guided for capex of up to 8,000 million. We ended this quarter with a total capex of close to 1,050 million, in line with the broad guidance for the coming 2 fiscal years. The 3 new facilities in Pune and Bhiwadi are set to enhance our footprint and support future growth. In the Pune facility, we have begun trial production for our pilot hub motors for electric vehicles. We are currently providing samples for customers for their validation and testing. And we have already spoken about the progress at the Chennai and Bhiwadi plants and expect them to bring considerable revenue. With that, I now hand over the call to Sumed to discuss our growth strategy and the way forward. Thank you.
Good afternoon, everyone. Thank you for joining the call. I'm Sumed here. Just to reiterate, our portfolio spans safety critical products such as metal chassis systems, exhaust systems, polymer components, body in wide structures, and proprietary engineered solutions like cross-car beams, suspension systems, steering columns, air tanks, etc. To drive future growth, we will focus on the following growth levers. Firstly, in strengthening our expertise in the two-wheeler segment, we aim to increase content per vehicle from 12,500 rupees to 17,300 rupees, driven by proprietary product offerings such as steering columns, braking systems, and air filters. While we have already begun producing these components for select OEMs, our strategy will be to cross-sell these to other OEMs in the coming quarters. We will also continue adding new logos as we did in this quarter for a top EV two-wheeler player. Secondly, on the four-wheeler front, we are sharpening our focus on expanding our footprint, both by bringing more OEMs into our fold and by deepening engagement with existing customers. This includes, number one, working closely with them on new model launches, such as the upcoming EV CNG chassis platform for a leading CV OEM. Number two, leveraging our growing design and development capabilities, as demonstrated with the long member manufacturing facility in the M and HCV segment. And number three, steadily increasing exports, as seen in our recent order win of 60 plus components for a luxury European OEM. Lastly, Belrise is steadily transitioning from a tier 1 component supplier to a tier 0.5 system supplier. This means
moving from delivering individual parts to providing complete, fully integrated subsystems and systems that enable OEMs to simplify their supply chains and accelerate production rollouts. While we've already executed this for two leading two-wheeler OEMs and a leading CV OEM, we're currently in discussion with another CV OEM to manufacture their complete chassis, a process currently managed in-house at their end. This will not only deepen customer entrenchment, but also increase value addition for us. From a macro perspective, EV two-wheeler sales were in line with expectations for Q1 FY26. However, due to the ongoing rare earth metal and material shortage in India, we anticipate that the two-wheeler EV OEMs will scale down production over the current and upcoming month. This is likely to result in lower sales for certain components that we supply, including motor controller casings, motor casing parts, steering columns, and suspensions that largely go into the EVs. That said, we do not expect this to have a material impact on our revenues. Next, given the current geopolitical situation, we remain largely insulated from the US tariff impact. Our exposure to US revenues is extremely small, resulting in a negligible impact on our overall performance. We expect our growth to remain primarily domestic, driven by strong demand from our core customers. Looking ahead, the outlook remains optimistic. The approaching festive season and improving credit availability is expected to lift retail sentiment in the coming months. Against this backdrop, Belrise aims to capitalize this opportunity on the back of OEM-driven outsourcing. With that, I now hand over to our CFO, Mr. Rahul Ganu, to take you through the financial highlights of Q1 FY26. Thank you for your time.
Yeah, thank you, Sumit. And good afternoon to everyone on the call. We'll be sharing the Q1 FY26 consolidated financial highlights. Total revenue for Q1 FY26 stood at rupees 22,622 million, up by 27% year-on-year from rupees 17,810 million in Q1 FY25. Manufacturing revenue for Q1 FY26 stood at rupees 18,323 million, up by 29% year-on-year from rupees 14,247 million on the back of a stable growth in two-wheeler, especially in exports, increasing content per vehicle, commercialization of new Chennai facility, and successful integration of H1 India into our basket of offerings. EBITDA stood at rupees 2,805 million, up by 17% year-on-year from rupees 2,401 million in Q1 FY25. EBITDA margin stood at 12.4%. This is in line with our EBITDA margin for FY25. Manufacturing EBITDA stood at rupees 2,536 million, up 17% year-on-year from rupees 2,160 million, and manufacturing EBITDA margin stood at 13.8%. Exports contributed 5.4% to our manufacturing revenue in Q1 FY26, that is rupees 985 million. Net debt of 30th June 2025 stood at rupees 7,698 million after paying up debt to the tune of rupees 15,960 million from the IPO proceeds. As of 30th June 2025, ROACE stood at 14.4%. Coming to the segmental performance on the manufacturing front, two-wheeler and three-wheeler contributed 82.8%, PVs contributed 4.5%, CVs contributed 8.8% for Q1 FY26, and others would be 3.9%. With this, we can open the floor for questions. Thank you. Thank you very much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question comes from the line of Manish Ostwal from Nirmal Bang Securities Private Limited. Please go ahead.
Yes, sir. Thank you for the opportunity, and this is my first call of Belrise Industries. So Pardon me if I'm asking the basic thing. So, sir, I'm just looking at slide number 5 of our presentation where we mentioned the revenue from trading of goods around 430 crores. So, can you explain what exactly we are doing in trading, and what are the activities we are doing in trading, and what kind of trading margin we operate generally?
So, thank you for the question. I think we have covered this briefly on the last call, but just to give a very quick brief on it, we trade in commodities like, again, high tensile steel, different grades of coil, some lithium-ion batteries, and so on and so forth. And the trading margins that we have are, of course, lower than manufacturing business, close to a 6% EBITDA margin.
Okay. The second thing on the capex plan, which you mentioned on the call, 800 crores of capex we are envisaged. So how we are planning to fund that thing? Can you make a comment on that? Thank you.
So yes, it is 800 crores over 2 years, so approximately 400 crores per year. We'll be largely funding this through internal accruals.
Okay. Thank you, sir.
Thank you.
The next question comes from the line of Abhishek Kumar Jain from Alpha Accurate. Please go ahead.
Thanks for the opportunity and congrats for a strong set of numbers, sir. My first question on the newly acquired business of H1 India. So if you can give the first quarter numbers, revenue and EBITDA of H1.
So in the first quarter, H1 had a quarterly revenue of close to 35 crores. This was down in this quarter specifically because one of their largest Japanese customers had a pretty tough quarter with their volumes falling by more than 40%. That being said, for the remaining 3 quarters, we expect revenue to ramp up sharply, and we expect this company to continue having a turnover of close to 250 to 300 crores, around 2,500 million to 3,000 million INR. In terms of the profit after tax that this entity generated, as far as I understand, was close to 2.5 crores.
And how is the operating margin of this business in first quarter, and how is the outlook going ahead for full year FY26?
So we'll not be commenting on the outlook for this particular business specifically. We have guided for stable EBITDA margins for the full business, and that's what we can commit to right now.
So just my question was on the first quarter EBITDA margin. Is it in the same line of the existing business, or it is lower than currently it is lower and it will improve in the coming quarter?
It is slightly lower right now, and that was due to the drastic fall seen in the main Japanese OEM that H1 supplies to. We expect this margin to become better over time.
So despite this integration, we have seen expansion in the operating margin in this quarter. Is it because that lower trading business revenue, and that's why the mix has improved in overall EBITDA?
So if you see the last fiscal year, we had an EBITDA margins for the full business of close to 12.3%, and this quarter we have ended at 12.4%. So we're largely in line with what we did last year. No particular increase that we can attribute it to.
Because ultimately, I see that other expenditure and employee cost has gone up. Despite that, we have seen a expansion in margin. So is it because of the lower trading business that attributed to?
The trading business, if you'll see on one of the slides, maybe slide 8, was around 19% of our consolidated revenue. Last year, I think it was close to 20%. So maybe a 1% revenue decline, but I think it's there and thereabouts. It's not a material decline in terms of the trading volumes that the business handles.
Okay. And My next question on the overall business in the sheet metal, you have very strong market share of around 25%. So just wanted to understand how is the market share in the motorcycle versus scooter. As you have a very strong presence in the motorcycle segment, but you are gaining market share in the scooter right now. We just wanted to understand how is the market share in each division and how is the outlook ahead.
So you said it rightly. We have largely been a motorcycle player with the majority of our revenues coming from motorcycles as compared to scooters. That's also due to the customers we started working with initially. If you look at our largest customer, they're largely a motorcycle player. That being said, I think the parts that we make, the chassis and the exhaust system, remain quite similar whether it is a motorcycle or a scooter. So us winning business in either one of them is dependent a lot on what the OEM is prioritizing. So it is not a conscious call we make of whether we want to remain in motorcycles or scooters or so on and so forth. It really depends on what the OEM wants to offer to us and what we feel is feasible. I don't know if that answers your question.
Sir, actually, if we see the two-wheeler mix, not that is shifting from motorcycle to scooter, and just wanted to understand what are the key business win you have in the scooter segment, and what are the plans to gain the business in the scooter segment to just compensate or make a better mix in the coming years?
So we already have a good exposure in the scooter segment. It's not like we're lacking in that segment in any way or form. If, say, an OEM wants to shift more towards scooter volumes, that will be directly shown into our mix also. So just reiterating, we're not fixed on working on any of those particular, segments. It is only that our OEMs were working more in motorcycles up until now. And now if they move into scooters, we'll follow suit. Maybe our chief marketing officer can add more to that.
Just to clarify, if you look at the largest scooter manufacturer in India, we have a very healthy market share over there. That's what I would say.
Okay. And who is your competitor, sir?
Thank you.
Is the sheet metal?
So in the sheet metal space, in the listed space, it would largely be JBM Auto.
So it's a Neil Metal or JBM Auto?
JBM Group.
JBM Group, right. Okay, and my last question on that, what is our current cash position, sir?
So current cash position as of June 25, I'll have to get back to you on that. But I think we had mentioned our net debt position, which was close to 750 crores.
750. Thank you, sir. That's all from my side.
Thank you. The next question comes from the line of Sheetal Keswani from Shriram Asset Management. Please go ahead.
Hi, sir. Good afternoon. Congratulations for the great set of numbers. So what I wanted to understand is, in your business verticals, is there an outlook that you have for the e-mobility business and the suspension division? Or is it that all of this is a part of your combined two-wheeler, four-wheeler passenger vehicles and CVs? How is it?
So thank you for the question. I think right now we're largely a precision sheet metal company with, I would say, more than 90% of our manufacturing revenues coming from the space. We have a presence in the polymer segment, which is, say, another 3 to 4%. Then we have another segment where we cater to renewables, defense, consumer durables, and so on and so forth. And then, as you mentioned correctly, we're also in the suspension space where we supply to multiple different OEMs. We not only make front forks and rear shock absorbers, but we also make the steering columns that we supply to multiple OEMs. So right now, to specifically answer your question, in the e-mobility space, the only bet that we have made is in the hub motor space, where we've set up a pilot manufacturing facility line in Pune. That plant has just been set up recently. So we are, as we speak, doing some sample validation and testing with some key customers. but no particular revenue that are envisaged in this business, say, over the next quarter, because hub motors, again, being critically safety product, will require a fair amount of safety and testing on the OEM side. To answer your question on suspension and steering column, I think suspensions we've been seeing good. We recently won an order, when I say recently, in the last year, won an order from one of the largest two-wheeler OEMs for one of their motorcycle models. And in the steering column space, we're working with 4 unique players. So we're working with a European player, and we're working with 3 of the largest two-wheeler OEMs in India. So again, both spaces we've had strong order wins in the past 6 months or so. And thus we expect this revenue to become material for us, say, in the next 2 to 3 years on the back of these order wins. And maybe our Chief Marketing Officer can, go ahead.
Sorry. So just to understand, so in the next 3 to 4 years, do we see the suspension and the e-mobility division being at a substantial number, or the sheet metal is going to be where, as you mentioned, like it's 80-90% of the manufacturing business, followed by polymers just being like a single digit, and the others is like another 3 to 4%. So yeah, the suspension division and e-mobility is more is where I'm trying to understand is from the perspective of having presence as in your product portfolio, or will that division be contributing, or that vertical will be contributing substantially going ahead, even if not in the next 1 or 2 years, but probably let's say 5 years.
So e-mobility, I wouldn't be able to comment on, given that it's too early and the facility has just been set up. It's a completely new area for us. Suspension is something that I can say is something with a more fair bit of confidence, where we've already been working for, say, the past 2 to 3 years. I think in the next 3 to 5 years, we would expect suspensions to become a considerable revenue contributor for us. When I say considerable, kind of getting close to a plastic or even more than that is, I think, where we think it can be in the 3 to 5 years region.
Oh, okay. Got it. Thanks, sir. I have one more question. It's on this.
Sorry to interrupt. May I request you to join the queue for a follow-up question, please?
Okay, sure.
Thank you. Before we move to the next participant, a request to all the participants, please limit your questions to 2 questions per participant and come back in the queue for a follow-up question. The next question comes from the line of Vijay Pandey from Nuvama. Please go ahead.
Hi, sir. Thank you for taking my question. I have a couple of questions. One on H1. So, just wanted to check. H1 is mainly a supplier of passenger vehicle, commercial vehicle, or two-wheeler OEM, because just want to check that decline is coming from which particular OEM, or trying to get an understanding of where the decline is coming from and how it is expected to move forward.
Thank you for your question. We unfortunately cannot comment on the specific OEM, but H1 is largely is a big player in the four-wheeler passenger car, commercial four-wheeler passenger car space, although it has contributions in the two-wheeler space as well, and mainly working with the Japanese OEMs.
Okay, sure. Thank you. And now, the second thing was on the margin side. Our gross margin also has declined YOY, and EBITDA margin also declined. Is it primarily because we did integrate H1, and that could have impacted, but just want to check what is the other impact that is driving? Was there any raw material impact, or how should we see it going forward? Like, we did 13% last Q1 last year, so.
So, a couple of points that I would like to preface this by. One is that last year we had an EBITDA margin consolidated of around 12.3%, and quarter one we went in with 12.4%, which we think is in line with the guidance we've given. And the second part is that our raw materials are on a back-to-back basis, which means that usually on a quarterly or say 4-monthly basis, we get the amendments in the POs from our respective customers. Nevertheless, there always is an increase or decrease in raw materials, and so the changes in raw materials does lead to a change in the percentage per se, but the absolute figures more or less remain the same.
So just in terms of, when the steel prices come down, do we get in the same quarter or we get it in the next quarter, the benefit, or like?
So we get the provisioning. We take the provisioning in that particular quarter itself. But if there's a decrease, then there's a decrease in revenue also, and there's a decrease in the particular consumption cost also. So when both the numerator and denominator increase, the EBITDA margin will of course change.
Within the same quarter, okay. And lastly, sir, our finance cost did go up to 80 CR from, so we did, because we made the payment of that, is it like, when do we expect this to flow into the lower interest cost to flow into the P&L? Will it be Q2 at the end of this fiscal year? Or is it, we have to,
Yeah, sorry. Basically, last year on a quarterly basis, our interest cost was around 77 to 78 crores. That has gone up to 80 crores. The main factor behind that was that for the H1 acquisition, we had issued a non-convertible debenture, the interest of which was not, captured in quarter 4, but is captured in quarter 1 of this fiscal year. And on your point on the IPO payment, the payments happened, started very late May when the IPO happened and went on until June. So technically, if you think about it, the impact of those payments was only for a couple of weeks, due to which that effect is not seen prominently. That being said, over the next 3 quarters, there will be a significant reduction in interest costs going forward.
Okay. And sir, what is our expectation on the manufacturing side EBITDA margin? Like in the presentation we have mentioned, it has come down from 15% to 14% this quarter. So just wanted to check on that.
So we will guide only on a company. We will guide only on a company-wide basis, and that's a stable EBITDA margins.
Okay. Thank you.
Thank you.
Thank you. The next question comes from the line of Niyati from Bhavya Growth Advisors. Please go ahead. Please go ahead with your question. As there is no response from the participant, we'll move to the next participant. The next question comes from the line of Shri Narayan Mishra from Baroda BNP Paribas. Please go ahead.
Hello, sir. Good evening. Congratulations for the great set of results. So my first question was on rare earth impact. So are we seeing our customers, delaying their production plans, and as a result, we are getting impacted? And was it also the reason for H1 revenues to be not in line with previous year?
So firstly, on the rare earth impact, cannot comment on our customers there, but as we briefly mentioned during our presentation, what we mentioned was there is a slight impact there, which will not materially impact our revenues because our contribution there is relatively low, and we expect that the Indian government will figure this out in the coming days because it's a issue of national importance for us.
So then, what will be our share of revenues to pure play EV OEMs?
Pure play EV OEMs, in terms of a percentage of manufacturing revenue, would be closer to 5%.
Okay. Okay. And so my second question was on this merger of group companies. Has there been any progress this quarter?
No progress as of this quarter. That being said, we are working on it internally, and as and when we have an update, we'll let you know.
Okay. Okay. So even till date, so as of today, there is no update, right?
So the only update remains is that, when we had filed for the RHP, we had acquired a 14% stake in Badwe Autocom. That is the only update that remains. Again, there's regulatory, requirements, and there's different types of approvals that is required before we go ahead with these acquisitions. We are working on it, and as committed, we look to complete the Badwe Autocom acquisition within this fiscal year, subject to the regulatory approval.
Okay. Okay. Thank you,
I
sir,
would
for
just like to
answering.
reiterate, we are given commitment to our RHP, so it is very, very clearly committed from our side, and it will happen. So nothing to worry on that part.
Okay. Okay, sir. Thank you. Thank you, sir.
Thank you. Before we move to the next participant, a reminder to all participants, you may press star and one to ask a question. The next question comes from the line of Avi from Ocean Finvest. Please go ahead.
Good evening, sir. Congratulations on the good set of numbers. So, sir, we have recently incorporated a new subsidiary to cater the defense and aerospace industry. So, sir, we are seeing opportunity in this space, like we have onboarded 2 new OEMs in this space. So, are we looking for active opportunities in the defense and aerospace industry?
So, as we've mentioned in our previous calls as well, and as we like to believe that we are fundamentally a process engineering company, and we can make multiple different products because of our expertise in this space. We are looking at expansion diversification. This is a new entry segment for us, which is largely defense and aerospace. It's a segment that requires long gestation periods and approval timelines. Well, we're hopeful a journey has already started on a positive note. As we mentioned on the call today, we have received a couple of orders already, including export orders which are coming in. So that is a very positive sign. And we are aligning our resources to work on new projects in this segment. And we believe there is an opportunity here that we'd like to capitalize on. Just one point I would like to add to that is that the defense and aerospace segment was something we have been working on for the past 2 to 3 years. So this first order has been 3 years in the making. So we feel it's a first positive step. As in, again, reiterating that while the first order may be modest, we expect this to further grow from here based on these 3 new customers that we'll now be working with.
So, sir, so the follow-up question would be, what are the R&D expenses we are doing on the defense and aerospace to develop products for the aerospace and defense industry?
So, in terms of the R&D, so we are largely a process engineering driven company. For defense specifically, the designs are floated by the customers, and we use our engineering capabilities to manufacture to the best possible accuracies for them. So it's more of process engineering in which we focus more on the dies, tooling, fixtures, and the lines that we create for manufacturing.
Just to add to that, it's a build-to-spec product, not a build-to-print product.
Okay, sir. Thank you, sir. Thank you so much.
Thank you. The next question comes from the line of Dhiral Shah from Phillip Capital. Please go ahead.
Yeah, good afternoon, sir. Thanks for the opportunity. Sir, if I look at our manufacturing revenue, that has grown almost 29%. And I can understand that our 4-wheeler and 3-wheeler contribution have grown up, looking at the acquisition that we have done. So what kind of growth we have seen on the 2-wheeler side?
So we have the percentages that are there in our investor presentation. We don't have them handy at the moment right now, but you can just do a simple comparison based on the percentages mentioned on page 8.
And with the exact specific numbers, we can get back to you.
Okay. And sir, our other expenses have grown, higher than our revenue growth. So it was up 40% on a YOY basis. And maybe that is the reason why our margins have, lower on a YOY as compared to last year. So any particular reason for, other expenses going up?
So one key reason for that was repair and maintenance expenses in quarter one were higher. I think they were higher by almost 2.5 times as compared to the same time, last year. And as you would imagine, repair and maintenance expenses are not really calibrated equally throughout the year, due to which they may seem higher. Second is that H1 has also been consolidated in this quarter, and it was not there in the quarter before, due to which some other expenses of theirs have also been added.
Okay. So going ahead, sir, are we confident of maintaining, at least 14% kind of an EBITDA margin on the manufacturing side? This is including the subsidy that we are, receiving across maybe a few plants?
So to answer your question, subsidy, the subsidy will continue to receive in the quantum of 100 to 120 crores, say over the next decade. We'll for now only comment on the consolidated EBITDA percentage, which is for which we're guiding for a stable EBITDA margin going forward.
Okay. Thank you so much, sir.
Thank you.
Thank you.
The next question comes from the line of Bharat Gulati from Dalal and Broacha. Please go ahead.
Yeah, hi. Could you quantify what would be if the defense revenue has started to come in from this quarter? And if not, then what would be the percentage that it would be of our total revenue?
It's still very early stages, so it's these new orders that we've received. At this moment, we cannot comment on on where this will go, but we're hopeful and we look at this as a new growth opportunity for us.
Okay. And out of the 800 crore capex that is planned over the next 2 years, which segment of that revenue is it focused towards? If you can mention, please.
So I think, of course, there would be a larger indexation on four-wheeler and commercial vehicles since we want to double our revenue in this space in the next 2 to 2.5 years. And apart from that, I think two-wheelers also will be something that we'll closely look at because I think, as we mentioned, we're starting work with a couple of new OEMs. And when you usually start work with new OEMs, it kind of entails the setting up of new facilities. In that sense, I think we should stick to the 800 crores over the next 2 years. The mix of it will be optimistic.
So would it be right to say that four-wheeler, passenger, and commercial will grow faster in like a segmental revenue as compared to two-wheelers?
Of course.
So is there some margin breakup that you can give us for that if it's possible?
We don't give segmental margin breakups.
Okay. And out of the 800 crore capex, is H1 also there in it, or is it purely, what is the breakup between the H1 and our traditional?
It includes H1. And the good part about H1, and maybe Sumit can talk more about this, is that when we acquire the facility, or even now, the capacity utilization that we have in H1 is not even more than 40%. So there's a huge scope to increase our revenues in H1 with the current machinery and assets. We don't think H1 as a company or as an asset will require a lot of capex for us going forward.
Actually, I think that was hit the nail on the head. Obviously, the automotive industry, the time to commercialization for certain products is, and the sales period is a little longer. So we expect that in the coming quarters, we can positively leverage that operational capability by leveraging our available capacities and expand that with little additional incremental capex.
So when can we see H1 ramp up? When can we see the capacity utilization reaching a higher number?
We've just taken over the company. It's been just a couple of months. We still continue to understand the company, integrating the company with our core operations. I think for us to come up with a definitive business plan will still take a few more months. We'll get back to you on that when we have a clear picture on it.
Right. Thank you.
Thank you.
you. The next question comes from the line of Shreya Tiwari from VT Capital. Please go ahead.
Hello.
Yes, ma'am,
Hello.
you're audible. Please go ahead.
Thank you for giving me this opportunity. So my first question is, as you mentioned in the presentation, that the company may enter into an Israel and Indian and Israel defense OEM. So could you share more detail about the company's product or component will Belrise be supplying to these defense OEMs? What the
Ma'am, sorry to interrupt. Your audio is not clear. May I request you to use any handsets, please?
Yes, sure. Hello, may I audible?
Yes,
Hello?
ma'am. Can you just speak a
please.
little louder, please?
Hello, may I audible? Hello?
Yes, ma'am. Please go ahead.
Hello. So my first question is that in presentation the company
Sorry, ma'am. We still can't hear you. May I request you to join the queue again?
Hello, am I audible? Hello.
No, ma'am. It is
Hello?
not very clear. You can join the queue again, please,
Okay.
for a question.
Okay.
Thank you so much.
Thank you.
The next question comes from the line of Deepesh from Manya Finance. Please go ahead.
Yeah, hi. Firstly, my first question was regarding the debt only. Since we've reduced the debt and but the interest cost has remained the same. Can you just guide on what should be the expected interest cost going ahead? Since we are also planning a 800 crore capex, where most of our internal accruals will go for this capex.
So the reason the repayment of debt has not affected interest cost is because it happened mostly at the end of May / June. So there was just a couple of weeks of interest saving that happened. And of course, that was offset by the non-convertible debenture that we took for acquiring H1. That is to answer your question. Is there anything additional?
No, going ahead, what should be the interest cost? That is what my the latter part of the question was.
So interest cost for us should be around 9 to 9.5%.
Okay. Fine. And also on the capex which we are doing, what will we be working on a similar kind of ROE, or will it be a better ROE?
So for the endeavor and initiative is to take us from, say, a mid-teens type of ROC company to a high-teens ROC company, and largely that will to do with taking on projects which have a higher RONIC, return on new invested capital. So in fact, with the plant that we're setting up in Pune for the long members, we expect to have a higher RONIC than what we have as a company, and the higher capacity addition that we endeavor to continue to get. So today we're around 65% capacity addition. We want to take that to a 70-74% capacity addition over the next 2 years. So we also feel that will bring in some advantage and will lead to higher ROC as a company.
Right. And when we mentioned that there is a transition from a tier 1 supplier to a tier 0.5 supplier, now can you just stress, how is this going to be beneficial, and exactly what will be a system supplier? I mean, do we set up factories at our OEM factories also? Is that the kind of work we are doing?
So to answer your question, if you look at the parts that we manufacture, they are from a weight perspective and volume perspective, they are very big. So traditionally, we've been setting up our factories very close to our OEMs. Now, regarding tier 1 to tier 0.5, the advantages are very clear because When we talk about a tier 0.5 concept, we are doing sub assemblies. That means apart from the parts that we do, like chassis or frames, we also add on a lot of other bought out parts on the chassis, and which is then supplied to the directly it's supplied online to the OEM. This has helped us to increase our stickiness with the OEMs. We become their preferred supplier whenever any new programs come up because of the kind of investments that we've done for them and the confidence that we built over the past many years by supplying almost a very large sub assembly to them, which goes defect free, which goes as per their requirements, and we have not had any issues up till now. So there are inherent advantages that we get.
Okay, great. Thank you so much, guys. All the best.
Thank you. Thank you.
Thank you. Ladies and gentlemen, we'll take this as the last question for today. I would now hand the conference over to the management for closing comments.
Yeah. I would like to thank everyone for the time, interest, and questions. I hope we've been able to address most of your queries. We remain confident in our growth strategy, both near term and long term, driven by strategic investments and a commitment to advancing products and technologies. For any further queries, please reach out to us or to our advisors, our IR partners, Strategic Growth Advisors. Thank you once again for joining.
Thank you. On behalf of Belrise Industries Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your line.
Thank you.
If you found this video helpful, please like, share, and subscribe to Concall India for latest upcoming Concall.